So, topic for today is unlocking credit for Bharat. Um, but maybe just to set the context amongst the audience, gentlemen, if you can talk about for your respective businesses, which is the customer segment of focus, as well as more about the credit product that you offer this customer in terms of loan amount, tenor, form factor. That might just be a good context to get us started.
I think I'll just talk a little bit about the opportunity. I think that's probably. I think I'm sure everybody here probably knows this, but see, India, if you look at broadly speaking, is deeply underserved when it comes to formal financial products. And if I can say specifically for credit, it's India is it's not even underserved. It's we are credit starved nation. We have been, right, and especially when we started this journey sometime in 2013. Finally launched the product in 2014. If you look at the household debt to GDP ratio among the developed nations, or among the top economies, right, we are still below 15%. China, for example, is at 65%. So I think there is a lot of room for us on the credit front, and specifically in credit, but more broadly in financial services products. And if you look at the incumbent players, right, banks and NBFCs has done a fantastic job, created great products. They've serviced. They've created products to service the tip of the pyramid. And if I can say, India is not even a pyramid when you look at the income. It's like a dome with a minaret on top. So there are very, very few people, probably like 30 million. Some estimates maybe call it 40 to 50 million, but I think maybe 30 million is a reasonably good estimate. And below that, this big fat middle of the pyramid, which doesn't have easy access. And I think there are reasons for it. And I think that's the challenge with which we started, right? Deeply underserved nation from a financial product standpoint, specifically credit. The incumbents find it hard to create the right personalized products for this mid-income, mid-segment India, which is earning somewhere between 15,000 rupees a month to maybe 50,000 rupees a month. And geographically, distributed, staying typically in tier 2, tier 3, smaller towns. Banks don't have that kind of reach, and they don't have the technology-based solutions to be able to service them at a lower cost. So I think that was the starting point. The second aspect of that was the lack of data availability from an underwriting standpoint, right? When you specifically talk about credit, again, typically because people have not had access to products, they don't have enough of a footprint on the bureau. Banking data is thin, but also hard to get because they're typically, banking with a public sector bank where it's hard to get bank statements easily. Now with account aggregator, things have changed, but I'm still talking smartphone. And the smartphone is the key because that is what we were seeing in 2013, 2014, that, everybody had a smartphone, everybody had access to internet. They were becoming savvier. They were consuming products and services on the mobile. So I think, and also assuming that everybody has a bank account, when we started, but today we have dropped that because we are also going to bank the customers. So, we are also a neobank today. So that's how the journey started, really, to create financial products for the large masses in India. And that's exactly what we've been doing. We are credit-led. We started with credit. And that's because, it's a pull product. Largest pool of profits reside there. Once you build the credit business right, which we believe we have been trying to do, it gives you the right to experiment with other products. That's the long and short bit.
I think whatever Sanjay said about the market, I think the macro story is very, very clear, very, very strong. There are divided opinions in terms of the target market when it comes to digital India for a lot of other sectors. But in financial services, the reading has been very clear. The need for digital from the customers is pushing the industry much harder. It's actually quite in contrast with other sectors. If you look at consumer internet, and maybe up to 5 years ago, you could have looked at insurance also, look at a lot of other sectors. There was divided opinion in terms of what the market size is. A lot of entrepreneurs, founders, investors probably had a slightly more inflated idea of how big the market was in consumer internet and some of the other verticals. But in financial services, surprisingly, it's been the other way. So actually, if you see the size of the market, it's humongous. The demand that we have seen, every month, the number of people that come to us, irrespective of economic cycles. So on one side, we saw that there was a recession, then there was COVID, then fuel prices went up. You pick any prices going up, from fuel to tomatoes, it has not changed the consumer demand that we've seen. So that's on one side, right? So demand has just been like an increasing curve for us. uh, for us, our journey, 2016 end is when we launched the product. So just a little under 7 years, but it's been very clear that no matter what you do, like Sanjay said, the one of the biggest profit pools are around credit in India. I mean, payments would have been fantastic for us as a country, but we're not part of the Durban Amendment like we are in a lot of other countries. So difficult to charge MDR. With that thought process, our product essentially started by being credit line. We believe we're one of the first ones to launch a credit line, a pure app-based credit line product. The idea of a credit line was very simple. An overdraft as a concept has existed for several years, but did not take off from the banks, right? So a customer should be able to, just with the convenience of a cheap phone with an internet access, be able to access credit in an affordable manner, but very fast. I think the fast was taken care of mostly by smart engineering talent and cheap data in services in India. But affordability was a problem which traditional banks have not been able to break for a longest period of time. Their OPEX, their CAC, which is customer acquisition cost, and their collection abilities, just prohibited their ability to go down to a customer and say, well, you need 10,000 rupees, I'll solve your problem. So customers could not borrow 10,000, 20,000, 50,000 rupee from a structured institution. Institutions refused to because there were no profit pools. The cost of servicing that customer was too high. And customers were left with no choice. I mean, you have to go and maybe, ask your uncle for 10,000 rupees. But how many times will you ask your uncle? And there's a price to pay, a social price to pay. So credit line flexibility is how we started our journey in terms of products. The idea of providing short credit automatically lent itself to other ideas such as flexibility in tenors. And traditionally, a lot of banks and institutions have looked at shorter tenors as a direct correlation with, hey, if you're giving short ticket, small tenor product, it must be a bad customer. It's actually quite untrue. So we decided to go with a few months of tenors, like 3 months of tenors going up to all like 3 years. Credit line, and then we diversified, got into personal loans and other formats. And so that's been our credit journey.
So very interesting and very useful. And I think, Kunal, I can substantiate your consumer internet point, because nowadays, several consumer internet companies are coming to us and pitching us that our business model is fintech. So clearly, I think, I think everybody is getting more and more aware of the profit pools. Back in the day when I used to work with Ola Financial Services, I think one of the surveys we did was to just understand how many of Ola's customers, and Ola is indeed a very premium service. How many of those customers actually borrow from friends and family or informal sources? And that number was nearly half. Half of very affluent customers are doing informal borrowings. So clearly, I think there is a market for small ticket size loans. Though I think while both of you mentioned this, I do want to, I think, discuss this, which is the lending market is large, and especially in what we call as Bharat, which is relatively lower incomes outside the top maybe 50 cities. But what are the economic challenges that formal lenders like banks and NBFCs face to address this market? And what is the primary challenge? Is it the higher OPEX of serving this market? Is it the high NPAs in this segment? Or is it that it's just not there worthwhile to serve these low ticket customers? I mean, what are the top challenges?
Well, I think, see, it's a mix of all the things that you're saying, right? I think one is, see, in credit, there is no one size fits all, right? So depending on the customer segment, you have to create the right product, and also based on the need of the customer. So actually, I differ a little bit on the short-term small ticket loans. I think we believe that, and this is for the middle India, the Bharat that we're talking about, right? People who are low earners, they still have aspirations. They still want, if they for whatever need that they want a loan, they want a certain size of the loan, and that can only be given if the tenor is right, because their ability to service the loan in terms of EMIs is still going to be small. So the tenor actually plays a very important role. I think the banks and NBFCs, they have faced broadly two main issues, right? One is customers have much smaller footprint on formal channels, so the data availability from an underwriting standpoint is very limited. See, banks and NBFCs have been very used to doing underwriting based on bureau information, right? Otherwise, there has to be some sort of a secured loan. It has to be a secured asset, right? Now, if the data is very limited, to provide a small ticket or a medium ticket loan, the profitability goes down because servicing costs are very high. They don't have digital processes to be able to service the loans. So I think uh, one is the availability of data, the other is the serviceability of the customers in tier 2, tier 3 towns for smaller ticket loans, relatively smaller ticket loans, I would say. And I'm still talking about potentially 50,000 to 1 lakh rupee loans, right? That's, I think, our average ticket, for example, at Moneyview is about 80 to 90,000 rupees. And the third thing is that this segment of customers, which we also talked about at the NPAs, this segment of customers also is very, very sensitive to any macro changes in the economy. So I think they also get into financial distress more easily. Uh, and we'll touch upon this later on, I'm sure, in the discussions. But that sort of also increases the overall losses. And there are 2-3 factors that are playing in that. One is that if you give small ticket, short tenor loans, they're sensitive to the macro changes, that they tend to go delinquent over a period of time. So I think that also adds to the problems, right? Banks are typically they're not comfortable in operating in above 3 to 4% annualized losses.
Kunal, anything to add?
Uh, I think in addition to what Sanjay said, maybe a couple of points. One, it's difficult to put a pulse on it, but it's also the DNA of the organization. It plays a massive role, and it's the weight of the DNA in terms of how an organization navigates is always underestimated. So look, I mean, a lot of newer organizations and fintechs, their thinking on the drawing board starts with saying, I have a way of approaching a problem, and technology is at the heart of how I want to approach the problem. And a lot of times you see business models being built with that core. So the atom or the core is a high power technology enabled solution to a problem. The problem is still a financial services problem. The customer still needs, customer is not looking for an app. Customer is looking for credit, or let's say a loan. So that doesn't change. Or customer is looking for a card to swipe for that doesn't change. But how you approach the problem can be fundamentally different, and that creates a complete different cost structure, your ability to move, navigate, move fast. So I think the DNA of the organization plays an immense role in that. And as much as we work with large institutions, banks, and NBFCs, all of us do as fintechs, I can say with confidence that it is a huge DNA challenge that they have. I think the second big thing is that their worldview is a lot centered around absolute risk minimization, whereas my worldview, running a fintech company, while absolute risk minimization does make sense, it's a lot to do with risk adjusted returns. Look, I mean, if you're a publicly listed company stock, analysts will hammer your stock if your NPAs go up by 30 basis points on an AUM of, let's say, 40,000 crores. So absolute risk minimization on absolute dollar value has its own repercussions in terms of your earnings, your ROA, pools, and everything else. So for good or for bad, a lot of large institutions have this pressure of absolute risk minimization. And because of that, the way their processes are designed, the customers they select, is heavily driven by that. Younger organizations can be a little bit more nimble because risk adjusted returns make more sense, at least in the early days. At least for the first 10 years, if you're building a 30-year franchise, the first 10 years, it takes you 10 years to find your footing if you're building a long-term company. I think risk-adjusted returns is something I'm more comfortable with. Economics need to make sense. And I think the DNA, on top of what Sanjay said. So in that sense.
So basically, would love to understand that, in your experience, what have been some of those digital channels that have worked well for you? Just like any marketer mentions, those three holy trinity metrics, cost, quality of the borrower, and scalability of that channel.
Sure. Yeah, I mean, this is one of the favorite topics that I'm sure like every marketing team or every founder is thinking about. At one point in time, every investor, every VC was thinking about. But I think the answer to your question, digital as a channel, customer acquisition, what's the story? Is it scalable or not? Honestly, the answer depends on who you're talking to, right? So if you're building a venture funded business, the answer is different from if you're building a business where you don't care about venture money, right? So a venture fundable business, and I worked for a very long time with investors and they're all my buddies, my classmates. I can tell you that venture fundable businesses have very different KRAs, right? If you're looking for high growth and high returns on capital invested and ROE is critical, then a non-growth scenario is a non-starter. You'll have ups and downs, but let's say if you average it out for a 5-year or 10-year period, non-high growth is a non-starter. So which channel gets you that growth? So answer is different, number one. Number two, what are you really trying to build? Are you trying to build an, let's say, a pure play lending franchise? Versus if you're trying to build a platform business, wherein, and your thinking and DNA and company composition completely changes if you do that. I mean, I can tell you with confidence because today we are a complete banking platform versus MoneyTap brand, which is only lending. A lot of our DNA has evolved. So the answer changes a lot. What has happened for us is that when we first started out, by and large, almost the entire customer acquisition was happening from the same popular channels, which is the performance marketing channels. And that was almost like taking money from the VC and giving it to Facebook. Like, why don't you guys just straight away go and pay each other? It's like it was a ripoff, honestly. The amount of money that everybody used to spend on CAC. That from being like an 85 to 90% when somebody starts a company in a venture funded environment, for us it has come down to like low single digits. It's like non-existent for us now, almost. So, but everything is digital for us. Like we are 100% digital. And within that, organic has shot up for us, at least. So we spent like a lot of time, a lot of elbow greases happened in the trenches, knee deep in muck, to try to solve every single problem and then to create a brand presence. Today, my organic acquisition is the largest contributor on my customer acquisition. My customer acquisition cost is negligible in that sense. So I don't sweat about customer acquisition. To answer your question, is digital a sustainable online acquisition channel? Absolutely. Can you sustainably handle the cost? Not without a profitable business model or without a sugar daddy. VCs, right? As long as Mayank is willing to write a fat check, some startups will be able to actually spend a ton of money. Eventually, you'll come knocking, calling, hey, where's my IRR? So again, depends on what you're trying to build the business. But digital, absolutely. If you look at the number of people coming on the internet, right? Today we have like what? Maybe, or at least let's say take by 2030 from here. If you look at the stats of what RBI plus the Indian Statistics Organization has put, we have more than 800 million people on the internet today. Right? The number of taxpayers has gone 10x in the past 10 years. Right? The average income of people and hence affordability of ability to buy a smartphone, the access of data has gone up significantly. Right? We used to have 1.5 million people paying taxes about 10 years ago. That number is close to 70 million today. Right? The average income was 90% of the people who were paying taxes, the average income was under 5 lakh per annum. 90% of taxpayers under 5 lakh per annum income in a year. Just think about that for a moment. 10 years ago, today, the average income for 60% or maybe 65% of the people is upwards of between 10 to 14 lakhs, tripled almost. Affordability of phones has gone up, digital access has gone up, people are spending a lot of time, the content consumption has gone up. Is digital a sustainable channel? Absolutely. But you have to solve for digital in this clutter or in this noise. There are like 1,000, like there were 600 apps banned by the Play Store and the App Store. So if you're not able to create a genuine brand presence with trust, a real product, your CAC will be astronomically high, and no amount of burn will be able to sustain that. I'm not sure it's a simple answer, but the one answer is digital a sustainable channel? Absolutely. But you have to find your way.
Basically, VCs skewing the marketing mix early on, and then you, I think, bringing back to sanity.
I think I'm sure those days are gone. I think see, customer acquisition is a complex problem to solve, and it's, I think, core to any business that you're trying to set up. But unless you set up a sustainable strategy for it, because growth is important, as you said, you have to grow, right? But unless the unit economics is working right, you will not be able to sustain that growth. So I think if you look back at our strategy, right, so far, we have always ensured a healthy mix, right? Digital marketing forms a large part of our spends today, but it only gets us about a third of the customers. A third of the customers comes from organic, and another third comes through partnership channels, right? The blended cost of acquisition, that has to be maintained at a certain level. And I think there are lots of things. Like today, if you look at credit space, for example, and of course, platform play sort of makes it better, but just on credit space, if you want to service more and more segments, if you want to service the Bharat, you have to underwrite deep. And that actually happens over a period of time. As your understanding gets better, as you are able to tap into multiple data sources, you are able to improve your underwriting models. And as you do that, you realize that your funnels are operating better. Today, we are operating at 35% approval rate at the top of the funnel. We get about 4 to 5 million customers on a monthly basis. That's a pretty large funnel. But there is a lot of appetite, right?
And I think one of the sub channels of organic, I'm guessing, would be word of mouth, or people sharing with each other. Historically, there had been this notion in India that, credit is a product of shame, and consequently, there are limited word of mouth effects because one feels shame in sharing. Do you see that in your data, or has the young Indians evolved beyond that phenomenon?
I think I'll probably rephrase my worldview of how I explain credit as a business, not so much as a business of shame, but it is probably two things. It is the oldest business in the history of human civilization, lending money. And it is the only business in the earth which is rewarded for intelligently rejecting customers. Every other business is the exact opposite of this. So credit is about intelligently saying no. Because like Sanjay said, it's very easy to go out of Koramangala here, stop at the signal, give money to 1,000 people, and you lose your shirt along with that. So I think the problem stems from the solution of the first problem, which is digital being prevalent. Everybody is able to vent everything. So I think the shame is kind of on a downward curve. People understand that it's okay to live your life. It's okay to spend money. It's okay, like Sanjay said, aspirations. People have aspirations. They want more money. They want a better phone, a better holiday, better clothes. Purchase financing is there. They understand that debt is a financial instrument. It's increasingly getting there. Over leveraging yourself and then not being able to pay back is a clear matter of shame. And unfortunately, a lot of players have actually played on that shame, which has resulted to unfair collection practices. When people call up the contact numbers and say, hey, give me the money, all of that stuff. Thankfully, the regulator stepped in last year and put a very hard stop to it. But that specific problem aside, I would say it's not so much of an issue today. But how has that resulted into, let's say, the impact of organic, to your point, the word of mouth, right? How does that play into the word of mouth? Well, honestly, everybody has realized that ultimately it's all based on trust. So can you trust a brand? Can you trust something? Not when you're most desperate. I think trust goes out the window when you're really, really desperate. But can you really trust a brand to do something? Having regulation, having a regulatory presence helps. Being around for a while helps. In a lot of cases, in our cases, gray hair has helped. But a lot of these matters have helped. So word of mouth has come from consistently proving, going back and saying that we have been around, we've been able to service customers, and it's a serious business. At the end of the day, as cool as it sounds, as startup and all, but it's a serious, very ruthless business. Credit is an unforgiving business. So as long as we've stayed true, not violated the code of conduct, fair practices, not done wrong by the customer. Whenever we made a mistake, and I mean, God knows, we have made so many mistakes as a company, but most times we've been able to just go up to the customer and say apologized, saying, okay, this happened. I can't tell you why a certain API failed at the backend and you did not get your money on time, but we apologize. I think that has helped us, and that has helped us keep the word of mouth on a steady rising curve.
Understood. So just to summarize the sourcing section, basically, initially, get yourself aware with your customers, through performance marketing. But over a period of time, if you're doing the right things, the business just compounds, by the organic channel developing, and you parallelly also develop the partnership channel, potentially, the SEO, ASO channel, so on and so forth. Understood.
Just want to add one anecdote as well, and some comment on the word of mouth. See, lending, yes, in India, borrowing money has been looked down upon, right? But I think the instrument matters, the kind of borrowing you're doing, right? So the instrument, the positioning matters. But I think the biggest thing which Kunal talked about is the customer service. And that's how the brand builds, right? I mean, today we are a 4.7 rated app on the Play Store. It's probably the highest. I think Credit is probably right about there, or maybe a point higher. But I think there is no other bank, no other NBFC which is at 4.7. And that is a direct result of the amount of focus that we have given on customer service. And especially in lending business, you have to put inordinate amount of focus and energy to ensure that you're doing your best and beyond your best from a customer service standpoint. And that creates the word of mouth. So we've tried lots of different schemes, rewards, which haven't really worked. But the anecdote, I had to go for a visa appointment at VFS. And, I was giving my documents to the officer sitting there, and he saw, you work at Moneyview. I said, yeah, I work. I said, why? He said, oh, I took a loan from Moneyview. I said, no, that's great. So I asked him, how did he hear about Moneyview? He said, the security guard outside told me. And 7 people at VFS had taken loan from Moneyview. So that word of mouth, that happens organically. I mean, if you try to seed it too much, if you try to recognize it and make people do it, it probably won't happen. But I think it's an indirect result of it. The customer service, the customer support, the how you treat your customers, that reflects in the word of mouth.
No, I think well said. Would love to move to the next section, which is underwriting. And the question really is that, unlike, a branch-based NBFC business or a microfinance business, where there is a luxury of, a human actually going to the borrower, maybe doing a visual investigation of their, home, workplace, potentially, doing the reference checks with neighbors and all the other very interesting practices that, this segment has developed. A pure digital business doesn't have that luxury. And we spoke about how, the segment that we are going after, might have cash incomes, might have non-stable incomes, might have low incomes. So how do we really underwrite these customers digitally?
With digital becoming such a big thing, we have seen that the digital footprint has increased of customers. Number one. So, which means more data is available without having to send a person to collect documents. Things are available. India Stack, account aggregator, bank statements, credit reports wherever possible. within the purview of customer consent and whatever is allowed as per the IT security IT Act, a lot of digital footprint is available. I think the complexity is after that in terms of how to make sense out of it. Second thing is, if you are clear to the customer that, look, this is needed, like I need these n number of data points from you. If you are able to share this with me, I will provide this value to you. If you are clear about this to the customer, you'll be surprised how much customers are willing to come forward and share. Obviously, as long as they know that it's through a legitimate platform, securities, data protection is maintained. Obviously, if you're taking the data and then selling it to somebody else, and the next day some NGO calls you saying, can you give me a donation? They're like, you're wondering what's happening. My data is getting sold. But if that is not happening, then you will see, and we have seen for a fact that customers have not really complained about providing data. Obviously, there itself is like a behavior disparity. The customers who are really in need of money will probably go to any lengths to provide all the information, and there you have to think about information legitimacy. Customers who may not be so much of a need, in which case it's a push product from your side, it becomes difficult. Like credit card is a push product. It's extremely tough. There's a reason why credit card acquisition costs are so high in the market. We are one of the first ones to launch a co-branded credit card. The economics of credit card is something which even, I mean, it's like imprinted in my head right now, all the learning in the past 6 years. That's a classic case. It's a push product, right? So, and lending in general is a pull product because of the massive need. Now we break it down into generally ability intent. That's like 101 in lending. Everybody understands that. Now with account aggregator, bank statements, all of this available, we are able to segregate and parse and basically call out information saying they are the whatever 20 variables that really make sense. And from there on, it becomes your ability to patiently try things out. Unfortunately, the struggle comes in, and this is where banks win, is that they have a lot of patience. And a lot of the new age companies don't have the patience. So you cannot throw capital and solve the lending problem entirely end to end. You can solve the acquisition problem, but you cannot solve the quality problem by just throwing capital at it. So you have to wait for the loans to come back. You have to wait for 1 cycle, 2 cycle. You have to learn the down cycle performance. So as long as you have the patience, which is where banks win actually, because they have a lot of patience. As long as you have the patience, you then go back and create a strong feedback loop. And you can start with, let's say, a sparse matrix of data. But over a period of time, because you build feedback loops, you go back and your sparse matrix starts looking much richer and richer. And I think the digital footprint is expanding a lot. Having said that, I do believe that there is still a lot of room for a phygital play, as they call it, wherein customers, if they're not able to provide you data digitally, they are open to sharing it even as a printout. It comes down to your cost structure and your ability to service the customer. And then from there on, you build your models.
Sanjay, for you, I understand that there are ways and means, both direct and indirect, come proxy data to understand the ability of the customers to service the EMIs. But in absence of bureau footprint, how do you go about assessing the intent of the customer to pay back in spite of all the abilities in the world?
Let's leave the bureau aside. I think there is a wealth of data available on customers, right? We started our journey actually before we got into the lending business. We started our journey as a personal finance management solution, and that's where we basically picked up the SMSs from customers' inbox with the consent and converted that into structured information. And when we started doing that, what we learned was, that there's a wealth of information sitting there. It provides you a 360 view on customers' financials. It gives you a lot of behavioral insights. It tells you about various affinities, payment behaviors, even on postpaid bills. For example, if you have a postpaid phone connection, you have a cable at home, right? So many of the data points which are typically missing if you just look at a single bank statement in the traditional underwriting world, right? So I think deeper understanding of this data has been instrumental, which has gotten us to this place today. So And that is just one kind of information. There is a lot of other behavioral data that is available. Of course, you'll have there are with the data protection bill and the guidelines from RBI. So especially in segments, I think the approach that we typically use is that if you have at least data on two dimensions, strong data, which can help you understand customers' financial profile better, risk profile better, then you underwrite for the loan that you can or exposure that you can take. But if you don't have the absence of that, you can go with a low and grow strategy where you take a smaller exposure and then sort of better performing customers, you grow them.
So there are a fair amount of budding, lending entrepreneurs in the audience. What is that one opportunity or one big hole in the market that at least you'd point some of our budding entrepreneurs to? I do have a leading question, which is, what does credit on UPI mean?
I think I was gonna talk about that. I think, see, UPI is a game changer. UPI has already changed the game. I think payments has transformed, and credit on UPI is the next big thing that is about to happen. It's already started with RuPay credit card already enabled with UPI, with credit lines on the banks already enabled with UPI, and we are hopeful that in the next some time, NPCI is also going to, or an RBI also going to allow UPI for NBFCs. So I think UPI is definitely going to be the big thing in the days to come from my side. So I think any kind of products that you can think of which can leverage the UPI infrastructure, I think it's a no-brainer.
Yeah, I think UPI is
Well, you are
definitely
not
a
allowed
win.
to say credit on UPI again.
That is definitely a winner. But I think one thing which is completely coming out of the blind spot right now, and it is a little bit in my blind spot, is LLMs, which is Gen AI. We've started using it in the company across teams, and it's surprising. I mean, I didn't even know that we were using it the way it was being used. But in terms of opportunities, the next step jump in terms of new business models and ability to kind of put products out there at a completely different view of OpEx is potentially going to be powered a lot by generative AI and LLMs. So I think that's one thing. I think it's going to really change the way things are operating today, and especially how you think about the business. I think in terms of the macro and the opportunity, it's just like crazy. So I don't think I would point out anything. We already spoke about it. But I think in terms of how you are building a company, I think the next massively disrupting company is going to be 50 people. It's not going to be 1,000 people. I think 50 people company with like very intelligent ability to understand and use language learning models. Obviously, scale differs, but as a new entrepreneur, is going to be completely different. And this is something which people don't know how to put a pulse on yet today. So it could go either way. So it could be the odds are like, worst case 100% capital lost, best case 100x gain. So I think that's a big opportunity.
I feel a lot more comfortable about the two investments we have done recently in Fintech, which are on back of credit on UPI trend. Thank you so much, Sanjay and Kunal, for agreeing to come to the Stellaris Fintech Forum. Thank you so much.
Thank you.